What typically happens to stocks when the Federal Reserve starts to increase rates, Treasury yields start to go up? What usually happens? Do we need to buckle up right here and see what's going to happen with the market? Is it going to be a wild ride? Well, nobody knows for sure, but I've got some great charts. I think you're going to love them. I'm going to show these to you to really give you a historical perspective on what usually has happened to stocks when the Federal Reserve starts to increase interest rates. So let's get into this. I'm going to show you these charts. First of all, my name is Bill Wilkins, certified financial planner, practitioner. Been doing this about 30 years. If you find this information helpful, please share it out on your social media. Copy the link on the video, send it out, hit the like button, all that good stuff, and that'll help us get out to more people to hopefully help them out. Anyway, let's get into this. I'm going to show you this right now. There's 3 charts I want to show you. Very interesting charts. The first one on board here I'm going to bring up is this one. So this should give it away a little bit right up front. Big gains have historically followed initial Fed rate hikes. Well, why is that? You figure, oh, they're going to raise rates, it's going to start to curtail everything. Mortgage rates might go up, all that kind of stuff. Well, usually when the Fed's raising rates, we're in the middle of a pretty good economic cycle. Things are going up, right? So you're starting to see inflation, which we think our personal opinion is in inflation here recently is really definitely a supply issue, a lot of issue on the energy, workforce and type of thing. So we think eventually this inflation is going to settle out. However, let's look at this. 9/11 of 1958. So this is 8 different cycles of the Fed increasing rates at different periods of time. So we go back to 1958 through December of 1961. The S&P actually gained 49% over those 3.3 years. And I'm not going to go through every single one of these, but as you can see, the average increase of the S&P 500 to when it hit the next bull market peak. So we hit that peak and then we had a drop of 20%. The average increase was 67%. And then the number of years that happened was over 3.4 years. So then the last one that we had where the Fed started increasing rates was back on December 16th, and it's right next to me there. 2015 ended in February 19th of 20 when we had COVID-19 breakout, but the market had gained 63% through that period of time. So that's number one. Now, let's look at the 10-year Treasury yield. So this is different. We're looking at when the 10-year Treasury yield is going up and what happens to the market during these periods of time. I need to move this over a little bit more. Let me blow this up a little bit better so you guys can see this. I'll cut into this. But what this is showing, for example, is back in 1962, December, through August 29th of 1966, over about 4 years, 44.7 months, the 10-year Treasury went up 1.7%. So what that means is, let's say it was sitting at 2%. It ended at 3.7%. I'm adding that 1.7 on there. But the S&P through that period of time still gained 18.3%. So the worst thing we ever saw was March of 71 through September of 75. Remember, you had Vietnam going on then. You had the oil embargo going on. We came off the gold standard. A lot of things happened back then that aren't technically happening today. But again, no guarantees of this. But the market dropped 18.1%. But there's only 2 other times. So out of these 16, 17-year cycles, there was only 3 of them where the market actually dropped, and there was really only one that was significant, a period of 18.1%. On average, the market went up 17.3%, and it was successful going up 78.6% of the time. So you can definitely see there that, again, another chart, even with rising interest rates on the 10-year Treasury, which impacts all the mortgage rates, a lot of different things impacting by that 10-year Treasury, that we've seen the markets actually still go up most of the time. But the last chart I thought was very interesting as well, which, and there's no guarantees like this, guys. You're going to see volatility. If you're in the stock market investing in companies, you're going to have some up and down. But let me get out of the way of this so you can see this too. But this is the pullbacks and returns. Let me see if I can get this out of the way. Here we go. I'm going to disappear. So midterm years see the largest intra-year pullback. So pullbacks and returns a year off the lows for S&P 500 index based on the 4-year presidential cycle. So obviously we just went through the first year of President Biden, the Biden administration. The typical average pullback is 12.9% that first year, but then you usually have a rebound. You're up 12.1%. The second year usually see a pullback of like 17.1%. So obviously a little stuff going on temporarily with the interest rates, inflation. Maybe we get this pullback. No definite, but what is shown in the second year, it's actually, if you hang on and can absorb that volatility, you ended up 32% off of the lows. So even though it dropped 17%, it went back up 32% during that period. So what are we saying here? Obviously no guarantees, but rising interest rates typically aren't a bad thing for stocks. So we clearly believe that there is still some potential. Oh, and you got a twin on there of me. Let me get myself off. Still have a potential to see some increases in the market going on. And typically we don't want to have our clients invested in the market unless they've got really, to me, 6, 7, 8 year horizon on there. And we set up different buckets of money where they're going to tap into over different periods of time. So obviously the shorter term money they're going to need is going to be a lot safer. Then you start getting to something more aggressive, has more risk in it. We have some different types of protection strategies that we can pursue with tracking the markets and that type of thing. But still, no absolute guarantees. But as you can see, don't give up hope because you're hearing all this gloom and doom about potential stock dropping because interest rates are going to rise and all that type of stuff. There's many factors, and it's very hard to time the market. And if you can set up your portfolios in different buckets, I think it'll help you absorb those short-term volatilities a lot better. So if you need to contact us, 513-641-6307. If you want a complimentary consult, we can do that. You can actually go to our website right here, pursuefinancialfreedom.com. Click on the complimentary plan link. At the very top, there's a tab. Fill out that data. We'll get a notification. We can get to you. But like I said, share this out if you can. Hopefully it can help some other people as well. If you want to subscribe to the channel, please do that as I roll my disclaimers. But appreciate you joining on. Any questions, give us a call. Other than that, have a great rest of your day.
Too many days in the darkness without a glimpse of the light, running tired and broken and scared, but I swear I'll never give up the fight.